Thank you for everybody joining us today. I know it's a busy week. We'll try to fly through this as quickly as possible, but there's a lot to cover. My name is Jeremy Scott. I am the Director of Research for Investors at Similarweb, and today we're going to be walking through some of the major trends that we've seen out there in the digital ecosystem and how that's going to impact 3Q and then 4Q guidance. So last quarter, the subject of the earnings preview was title shift, and that was given the sea change underway at the time and some of the data. So keeping on that theme, we thought it was fitting to title this Rocky Bottom, and we're going to see a lot of the charts today with very similar shapes from over the past 3 years, but quite divergent bottoming patterns in the last few quarters. If it's your first time joining us, we are Similarweb. We're the leading provider of online data with 1 billion websites and apps covered. And the core function of my team is to leverage the vast amount of data that we collect on a daily basis, package it for our clients so that they can monitor both real-time trends as well as dig deeper into individual names. So the agenda today, we got a good amount to cover, broader thematics and debates that we use our data to track, earnings from ecom, TMT, and then SaaS. So we'll start with the thematics. Here's some of the big debates that we're following, and these are going to string through each of our company level previews. The first is the CFO in the driver's seat, so the impact of more draconian budget cuts that are growing in size and scope. Social network defects, this is the impact of the deterioration in social commerce channels. The streaming race for the bottom, so this is the landscape that's on the cusp of a major shakeup, and it comes at a pretty important time. Big ticket purchases on hold. This is the first order effect of some of the macro pressure that we've seen. And then finally, return to office withering, the resistance withering, so the impact of which is going to touch nearly every sector from SaaS to food delivery to travel. So I always like to start from a very high level to observe the momentum leading into the quarter and then after it. These are global heat maps. This is the categorization of traffic across 5,000 of the largest domains, and essentially what we're seeing here is it's softness, but it's not complete destruction unless you're in crypto or retail investing. Certain categories like travel and food delivery beginning to slow after a strong start to the year, but if you look at retail and ecom, traffic is actually starting to thaw and beginning to improve, and some of that is easier comps. Some of that is due to the impact of multiple Prime days, inventory liquidation. So this is the high level story, but let's unpack the drivers. We'll start with our key thematics. So the first trend that we're tracking is CFO in the driver's seat. So what does that mean? It means optimization. It means all of a sudden we don't need as many seats on Asana. We don't need an enterprise license on Zoom if we have Teams. We shouldn't be spinning up extra servers on AWS. There's tons of excess, as you all know, that has built up over the course of the pandemic, all in the name of productivity, and the pencils are now sharpening on usage. So the debate is, where does that stop? And if you look at the two charts to the right, which is the 3-year growth in active users and active accounts, both vendor and seat consolidation it's not exactly a new development. So this is client level activity on more than 100 SaaS platforms. And if we look at it on a 3-year basis, comparing today to pre-COVID, we're now in the 5th straight quarter of deceleration in both users and accounts. In other words, this is a trend that's been dating back to the 3rd quarter of last year. And at that time, most of the cuts that we saw could be attributable to an S&B pullback, concentrated in communication and collaboration, and some of the self-serve CRM tools. Today, these cuts are a bit more broad-based. They span the spectrum of client sizes. So both enterprise and S&B are making choices to consolidate, which is creating that widening gap between the nice to have and the need to have. So the debate again is, where does this stop? Well, we certainly don't need to have 4 to 5 different collaboration platforms, but you absolutely need to maintain identity access management, integrated functions. Anything that's not nailed down in integration we're seeing is at risk. And I think if you look at some of the CIO surveys that have come out from sell-side brokers, this mirrors a lot of that trend. And you can see in the bottom left chart, which is year-on-year growth, the rate of consolidation of both seats and accounts has not meaningfully worsened in the last 3 months, but certainly still contractionary. The next secular trend that we're tracking is social network defects. So we're all following closely some of the structural changes on the social space, at least on the platform side, and we'll share the impact of that a bit later. But we wanted to look at this from the other side. So we analyzed the top 250 Shopify brands in terms of the social traffic referrals to see if we can isolate the impact of the lower effectiveness in targeting. So these are the largest D2C brands, which are heavily dependent on precise demographics for effective targeting. And the impact is pretty clear. So as a share of traffic, social has lost 3 points of share since 2020. It's even bigger when you consider conversion. The last time that social was a positive contribution to traffic was pre-iOS 14.5, so about a year and a half ago. And if you were to do this on the top 100 or top 1,000 brands, that mix shift would be even starker. So that has a very clear implications for future advertising allocations. And what's taking its place, it's a good portion of that has shifted to paid search. So you're seeing money flow from the traditional social landscape towards more of a Google. Next up, we can't go a whole preview without mentioning inflation and some of the first order effects. So I mentioned in the heat map slide that some of the we're seeing softness, we're not seeing complete destruction. When you double click into certain categories, though, you will find that weakness. And today it's the big ticket categories such as home and electronics. Now, these categories have been soft for 6 months now. So the question is, how much worse does it get? Well, one major shift that we've seen in the last 3 months has been inventory liquidation. So from a traffic perspective, it's pushed up categories like athleisure and apparel to the top. And that's really where the consumer mind share and wallet share is flowing. But while traffic has recovered somewhat, transaction rates continue to decelerate. So you can see in that right-hand chart, that's created a pretty significant drop in Q1Q conversion rate up year-on-year for Q1Q conversion rate. It's rare to see those two lines, transaction and traffic, move in opposite directions. So when you do, there's an imbalance. Next, streaming rates to the bottom. So it's shaping up to be another quarter of pretty soft net new household activations for streaming platforms, at least according to our index of clean signups through self-service. So this doesn't include any partnership impact, doesn't include reactivation from canceled accounts, which is different, or a different flow. So you can make of this what you will, but it seems pretty clear that the third quarter will mark an end of an era of streaming, which with the launch of 2 major ad-supported platforms, and that comes probably at the perfect timing, given that experienced the net new signups in negative territory for the first time. And finally, on the structural trends, the boomers are back in the driver's seat here with regards to their return to office motion. Companies are driving their return to office. The stats that we're seeing in our meetings impact is mirroring that we're seeing that in the office occupancy and ridership. In terms of global meetings, we're at about 40% of peak. What's more interesting is that the industries that were resistant throughout all of 2021 that were still growing users throughout the year, such as CMT and professional services, are now seeing double-digit declines in both use and account. So this return to office momentum is pretty broad-based. It's also showing up in Zoom phone account activation. So if you've been following Zoom, there's a big debate around PBX motions and the fall starts. It's had, account visits to the PBX page up about 120% from last year. That compares to a 50% increase in the beginning of this year. So in terms of 3Q earnings, here are some of the key callouts that have hit our screen. So not too much on the upside here. Shop is interesting because we saw some surprise uptick in D2C channels. Now, mind you, we just talked about how conversion rates were down, and some of that traffic, which is driving our GMV index, might be promotional frothiness, but nonetheless, it's still important to see any positive momentum here, given the market environment. And Pinterest, another controversial and probably surprising one, given what just happened with Snap. Obviously, a better setup today as expectations have reset. We don't expect any social media company to be optimistic about guidance in this market, but our data is pointing to some momentum forming, at least when it comes to advertiser interest. On the downside, most of these shouldn't be too controversial, with the exception of Airbnb. We know that there's some channel checks out there that cited some really solid trends in the quarter. That is not something that we can confirm, at least on our volume side. So ADRs might be a different story, but from a volume perspective, it looked a little bit softer in the quarter. And then Amazon AWS, we're tracking weakness across the cloud space, but particularly in smaller customer cohorts. So this is a key source of growth variance for AWS trends. Definitely seeing some pressure in the long end of the tail. LegalZoom facing a small business washout, so sharp slowdown in checkout transactions. Wayfair and Overstock facing big ticket softness, and Peloton continues to have difficulty moving products. And then we look on a sector basis. So we track our coverage. This is more than 200 companies, and of those 200, we have roughly 50 that are showing trends that are directionally different than expectations. We've broken it down for upside and downside. That leaves both upside and downside, which is interesting. So there's a separation here of nice to have and need to have. Need to have last quarter may have guided down too much, whereas nice to have has seen accelerated pressure into quarter. Same goes to internet platform. There are some positive bounces at the bottom, but there's a few in our coverage that have more room to cut. On the big movers from last quarter, so last quarter, retail hardlines was the top spot in potential downside. This quarter, it's third in potential upside. So management teams really slashed guidance last quarter and set themselves up for less, disappointment in the second half. So data would show there's no reason to get too positive on 4Q. Food delivery and retail marketplaces were both leaders in the upside column last quarter and are now tied for second in the downside column. As you saw in our heat map, food delivery has been under pressure, and that continues into October. On marketplaces, Prime Day shift did have an impact on the rest of the market, and that may not be fully baked in. But we're also seeing a lot of DTC inventory liquidations that have potentially been driving traffic and wallets away from marketplaces. So moving on to earnings, let's start with retail and e-commerce and Amazon retail. So recovery in the 3Q here, in part related to that Prime Day shift. It's come at the expense of our marketplaces, as we just talked about, and mass market retailers. So when you look at the conversion share at the bottom left-hand chart, Amazon versus Walmart and Target online, this is our favorite incomplete market comparison. You can see that Amazon has consistently pulled back transaction share since the start of COVID, when both Walmart and Target benefited from that grocery surge. And then finally, on the bottom right-hand chart, you can see the net recovery in Prime user movement. So remember, Amazon took that price hike in February, which drove up cancellations, at least in that quarter, and it really dampened new signups for both 1Q and 2Q. One potential driver of these net movement trends has been the streaming content. So a couple months after the price hike, saw the Amazon announce that Thursday Night Football will be exclusive in 2022 versus 2023. Of course, they spent a ton on Power of the Rings, which has been very successful. There's also been a lot of discussion on Amazon playing a key role in rebundling. So it seems like streaming is shifting from that sweetener to becoming a main incentive in terms of its contribution to value to Prime. And in terms of the markets around it, so Amazon Prime Day shift has been costly for its competitors. Remember, we just talked about in our sector breakdowns, but one particular was Mercado Libre in Brazil. We've seen the third quarter deceleration in transactions versus expectations for flattish. In fact, nearly every Brazilian marketplace showed near-term weakness in 3Q. Now, the Prime Day impact on Melly is certainly transitory, but another headwind that might be abating is the impact from Shopee. So C Limited, which has been incredibly aggressive over the last 3 years in expanding its Latin American presence. They announced in September they're going to be pulling back into Latin America, exiting the markets of Argentina, Chile, and Colombia. So while the chart on the right focuses on Brazil, where Shopee will remain, it seems pretty clear that the tactics it used to win that market share aren't necessarily repeatable in a risk-off environment. So certainly a positive there, given that the market share pull from Shopee over the last year or so. Headwinds remain in monetization efforts, though. Melly has been pushing both fulfillment and payment as key points of integration in a very fragmented e-com market with a lot of success over the years, but we analyzed the payment and listings penetration. It appears to have stalled out in the last few quarters, which may be limiting further gains in take rate. On Etsy, similar trend line, different story. GMV is decelerating, much of which is based into expectations. The key here for Etsy is really seller health. If you remember, it was back in April where the company announced that they were raising their seller fees from 5 to 6.5%, which prompted some seller protests. The second initiative that ruffled feathers was the buyer protection, which enables buyers to get an instant refund if the product was not as described. So in a marketplace of handmade items, you can see how that would be a challenge. But as you can see from the bottom right-hand chart, seller growth. So these are the number of sellers that are logging in and checking their store had already been coming down for 3 quarters before that seller fee increase, and now it's actually starting to turn positive. So we're actually starting to see engagement recover, and the key leading indicator of that is the ratio of buyers to seller, which despite some challenges has been pretty solid and stable. And then unlike other major marketplaces in terms of promotional activity, Etsy has a few tools in the toolbox that mostly has to rely on the sellers to set prices and promote. These type of dynamics create demand headwinds in a highly promotional environment. But despite that fact, we're seeing a really good ratio of active buyers to sellers. It's not exactly translating evenly into conversion. So as you can see, that top right-hand chart, buyers are starting to return somewhat, but the fervency in which they execute a purchase is continuing to decelerate in the bottom left-hand chart. And speaking of limited discounts, the management team at Revolve has made it clear that they will resist the urge to use promotional activity to pare down their inventory. This type of brand protection is obviously not a new strategy, but these are extraordinary times in terms of market dynamics. Interesting thing that from a traffic perspective, they're still vastly outperforming the broader fashion space, but the conversion rate has been relatively stable. And you can see from the markdown rate has been relatively low, or markdown visit penetration, I should say, relatively low compared to history. So given all that, we're of course seeing deceleration in 3Q against a really difficult comp, and that doesn't necessarily get easier, but it's likely shaping up to be not as bad as expected. On the other side, not too much to love about the third quarter for Wayfair and Overstock. As we spoke about in the intro, consumers are definitely putting off big ticket purchases, which includes home retail. It certainly makes sense that if there's continued pressure to come back in the office, home upgrades may take a back seat. Either way, not seeing too much movement here in the quarter with Overstock and Wayfair companies to watch. Is potential downside versus expectations. Little to get excited about for the remainder of the year. In terms of inter-quarter trends, Wayfair started out stronger, ended weaker. Overstock started out weaker, ended stronger. So moving on to TMT, for Meta, it's been a difficult year to say the least. And as we mentioned in our introduction, it doesn't seem like it's going to be a whole lot better, given that it's really a slippery slope of audience targeting, especially in small business and D2C channels, which are so utterly dependent on precise demographic campaigns. So taking into consideration that D2C chart, these patterns shouldn't be too shocking. We've seen a pretty significant pullback in engagement on the Ads Manager portal, which is what we're measuring here in a trailing 6-month basis, as well as engagement on the ad creation. And that trend progressively worsened throughout the quarter. So the top left chart shows ad portal engagement. It looks like it's flattening out a bit, but that hides the intra-quarter decay. And then in the bottom left-hand chart, you can see the funnel. So the blue line, those are users interacting on Facebook business pages. You can almost consider that to be your pool of potential advertisers. And that's been pretty stacked for the last 12 months. And then the red line is the ratio of advertisers to business users. And that just, it's a measurement of ad intensity or activity or intent. And that just continues to drop. And then the top right-hand chart, that's the global social advertising manager share. What that represents is users logging into the ad manager portal in aggregate. And of course, Facebook still has a dominant share and still above pre-pandemic. So you can see how much engagement as a whole has softened since in 2022. And of course, slowly eating away at that is TikTok, which, given the rumors yesterday, basically attributes the share, at least on a global basis, is about 15%, or sorry, less 10%. So what's also been interesting here is the rise in Pinterest, both in terms of user engagement as well as advertiser engagement. And Pinterest is one of the call-outs on the positive side this quarter. They've really built off the momentum of Idea Pins launched from about August of last year. the partnerships they've layered on top of that. Now, obviously, with what Snap just reported, we need to be sharpen the pencil about what ad portal engagement actually means. So there's a lot of different ways to track advertisers and their things on the portal, but suffice it to say, just like traffic doesn't mean a sale on e-commerce, engagement portal isn't necessarily a dollar per dollar that goes with the same. So you can see in the top left-hand chart, the relationship between ad engagement and revenue is pretty good from a directional standpoint in magnitude quarter to quarter. So you can see there's a clear moving variable that changes the relationship over time. That being said, we are seeing a slow rebuild in engagement on Pinterest ad portals, especially when compared to legacy platforms. And given the flushed out of expectations that Snap just created, this potentially created an opportunity of identifying relative outperformers like Pinterest. After all, Pinterest does not face the same competitive challenges as Snap, and they've been pretty successful layering in short form video formats with its partners. Moving on to travel, it's been a bit of a roller coaster in 2022 thus far. Really started the year exceptionally strong in nearly every category, as we talked about in the intro. And then right around April and May, when consumers were booking their summer vacations, it starts to dip again. For Airbnb specifically, which is not really going to benefit from a recovery in business travel that we saw in summer. That was certainly the case in 2Q and 3Q. The reason why Airbnb shows up in our potential downside risk is we know there's been some positive challenge PTON data out there and have pointed to really good momentum in the quarter. And a lot of the focus was on ADR, but I think there's also some positive comments on volume as well. We're not seeing the same trends. So we track Airbnb a couple different ways, which is, A, the number of users checking out and converting across regional sites. The other method, which is our preferred method, is looking at aggregate engagement, so total time spent on the site, which you can see is a pretty good track record. Both methods are pointing directly down this quarter. What's interesting is that the quarter actually ended up stronger than it started, which is opposite of how travel, which had a nice bump in July, August. So, and one of the qualitative trends that we've pointed out in the past that maybe become a bigger factor in the second half is how hosts are passing through inflationary pressures through fees. And those fees are usually showing up in the checkout process. So the two trackers that might be impactful there is conversion rates and cancel rates. So a drop in conversion rate would typically mean that customers are getting to the end of the checkout process and deciding against it. We've seen a bit of a dip here, especially in Europe, but it's not meaningful yet. The second area is cancellation rates, and that's relative to conversions. This one can be a little bit noisier, but overall, we really haven't seen an uptick here. In fact, it's actually improved. So the good news is that A, fees are not really thwarting the checkout, at least not yet. And then B, consumers are following through on their plans once they book them. The bad news is that there's definitely some softness at the top of the funnel that emerged in the summer. So speaking of the impact of additional fees in the checkout process, food delivery is at a critical resistance point. It's really proving to be increasingly an unaffordable luxury. Now, Dash has been a relative outperformer in a very soft market, and that's a testament of two things. One, in the US, it's been the success of DashPass, which has grown both organically and through partnerships. And that mechanism is to cut the marginal delivery fee to customers down to basically zero. That's having a huge impact in market share positioning in this inflationary period. And one way that we can pick that up is showing the overlap of cross-shopping rates between DoorDash and other food delivery providers. We're finding that DoorDash is increasingly becoming an exclusive platform for many customers. So when you exclude Wolt, which closed last quarter, our index of order growth was essentially flat sequentially, which is in this market is flat is up. And you can see from the page share data against Grubhub and Uber Eats in the US that it's gained. And then the second driver, the key debate on DoorDash going forward is how well they can transfer their US execution to European markets with Wolt. It's still early days, but the best way we can track that progression is looking at keyword share in food delivery. It's still early, but there are definitely some positive signs. On Peloton, inventory issues likely to continue this quarter. Shop visits continue to decelerate. Recent product tracking on Amazon suggests there's little movement there as well, even as it was a feature in Prime Day. Meanwhile, our subscriber churn tracking is continuing to climb. That doesn't include pauses. It's not a good sign that they shift their model from hardware to software. That being said, clearly an industry issue. So it's not just Peloton. It's the company continues to gain share in at-home fitness market. In fact, it's likely to be one of the few remaining players at the end of this. And checkouts across the entire connected fitness space were down about 25%. Peloton faring slightly better than that. So this is a part of our structural story of return to office resistance withering, routine change, return to office demands, taking hours out of the household. What Peloton is missing today is intent, and they are trying to remedy that with partnerships such as with Hilton. But overall, there's little momentum to cling to this quarter. On Carvana, similar trends, different reasons. Buyers are clearly waiting out this market. Our index for units and sales continues to decelerate, and the rest of the year doesn't look much better from a comp perspective, as you can see on that right-hand chart. It only gets tougher. On the bright side, we are seeing recovery in sellers per user, which is a positive sign for potential inventory rebuild and may signal some accelerated thawing of the market. But overall, just a really rough market in terms of buyer intent, small glimmers of light at the end of the tunnel. And then moving from the car to the home, buyer and seller intent is even weaker here. Total consumer and realtor engagement on Zillow and Redfin continues to decelerate. For Zillow, rental traffic hasn't been much of a bailout. Both platforms are shaping up to post pretty dampened trends, but the good news is that expectations embed a lot of macro sympathy into estimates, and so there's potential room for upside, at least in the short term. And moving from the car to the home to school, so Chegg actually screens a bit more positive on subscriber numbers. So laps are certainly getting a lot easier. Engagement trends in the summer quarter had actually improved and were better intra-quarter. Churn rates continue to be relatively stable. Expectations, meanwhile, call for deceleration in the second half. So if you remember from our call-outs by sector, where internet platforms carried a high percentage of the upside mix, this is an example. So we're not exactly seeing much momentum, but it's not getting meaningfully worse either. So the downside risk versus expectation is more narrow than what we've had in the last 3 quarters, and this really embodies the type of opportunities you're getting on the long side, where so much of the pain has been priced in, and there's little expectation of stability. But there are examples in internet platforms where we are seeing some more stabilizing trends. And then finally on CMP, even though this is a bit more of a fintech, a couple names here, but I had to circle back to crypto and retail investing, given that they've occupied the bottom rung of our heat map data for the past 6 months. The good news is that the exodus may be slowing. The pace of user departure appears to be showing signs of a bottoming, or at least suggests that most of the weak hands have been shaken out. The bad news is that for both of these players, they've lost considerable amount of market share due to idiosyncratic issues and may not participate as evenly in a potential recovery should it come. And moving on to SaaS. So to say it's been a challenging year for Shopify would be an understatement. While the company remains heavily committed to addressing the growing pains in fulfillment, it faces substantial external pressures, including that looming threat from the Amazon's buy with Prime expansion. So they did make some recent management changes, take some cuts. Seems to be suggesting that they're digging in on fulfillment. The stock's down 85% from peak, undoubtedly a long road towards regaining investor confidence. Still, they face easier comps ahead. So investors might be positively surprised by 3Q patterns that appear to be stabilizing, if not modestly inflecting. But if you remember, last quarter, management gave commentary around the consumer behavior returning to pre-COVID patterns, particularly non-traditional categories, which is something we've been tracking for some time. Last year, we said there was about 10 points of headwinds in the reversion of non-traditional retail, and now we're beginning to lap that reversion. So again, and to clarify our GMV tracker here, it's based on aggregated visits from all merchants on Shopify that we're tracking. But as we mentioned in the outset, we did see a drop of conversion rates. So we would take that inflection and tease it down a bit. but with expectations calling for more deceleration this quarter, any sign of stability will be a welcome sign. A quick note on Buy with Prime, which is the boogeyman for Shop. We estimate that Buy with Prime is now integrated in approximately 300 online retailers, most of which have less than 1 million monthly visits and already sell their product on Amazon Marketplace. However, of those 300, more than half are Shopify merchants. So obviously a huge risk there. And despite accelerated investment in acquisitions, merchant applications to the fulfillment network, to Shopify's fulfillment network, which is a key indicator of demand for service, appears to be waning again. Next on Freshworks, we chose to cover Freshworks here because it embodies a lot of the pressures that we've seen across the SaaS space: high SMB concentration, relatively low switching costs, high exposure to Europe, and the washout continues. So while last quarter was better than feared, trends continue to decelerate in 3Q. Customers with less than 50K ARR, which represent about 60% of revenue, continues to be a key headwind. Top of the funnel activity, free trials indicated an ongoing difficult pipeline environment. However, the quarter ended better than it started, with trends strengthening in sequential months. Enterprise also facing headwinds. Top right chart on active domains. This is domains with over 100K monthly visits, decelerating for the 5th straight quarter. Most of that deceleration appears to be baked into the second half expectations, and there are a few regional bright spots and signs of stability. But you can see overall that Western Europe, Asia Pac, Australia, all notable weak spots, dragging down the overall growth rate. Of course, SMB CRM tools are going to become a critical battleground for the next couple months with the launch of the next couple quarters with the launch of Salesforce Easy. Next on Monday, which also embodies a trend that we're seeing in vendor consolidation. So as we mentioned, it wasn't rare in the pandemic for large enterprises to carry 4 to 5 different collaboration platforms, especially as there were relatively wide freemium layers. That era comes to an end. So core collaboration has evolved into this commoditized and crowded space where the largest operators have increasingly extended into full product suites such as sales, marketing, PM. And that's really the effort to grow from a nice to have to need to have. But for Monday, those new platform tools are early in their development cycle, and interest in these expanded modules, at least at the top of the funnel, has been relatively muted. Monday is likely more banking on the cross-selling opportunities to drive that adoption. So if you look at engagement per domain on the bottom right-hand chart, that suggests that these new modules are having some impact. So average unique users per domain has grown considerably in the last 8 quarters. Still, problems in the core remain. So we noted at the outset that SaaS consolidation really started in earnest in 3Q of last year and was concentrated in SMB. Today, those budget cuts are moving up the size spectrum. So you can see in the bottom left-hand chart, started in SMB domains 1 to 500 MDVs, now continuing into the middle market here with domains 500 to 1,500, and of course, enterprise looks weak as well. On LegalZoom, so of all our callouts this quarter, upside, downside, LegalZoom hits the most screens with regards to potential risks to the downside. And this is despite some positive trends in subscription churn rate and the new tax class. To be fair, however, the stock seems to be anticipating this. It's underperformed the market by about 20 points in the last 3 months. But new business formations are about the lowest they've been since we started tracking it. What's interesting is that the self-service funnel is soft, but it's not that soft. If you look at the bottom right-hand chart, what's happening is that we're not just seeing a lot of conversion in that funnel. So we're showing that there's users moving through the business formation funnel and they're just not converting. So the conversion rates are dropping pretty dramatically. So you can track that with lower confidence across the small business world, which is understandable. And then finally on cloud, so we've seen a ton of CIO surveys on public cloud spend, a lot of which is verifying what we're seeing in the data. The critical variable in the COGS line, cloud spend optimization, likely at the top of the CFO list of levers to pull. Portal logins, it's a noisy indicator, but our data suggests general sluggishness in the overall market and horse trading among the largest players. In terms of account growth, which is what you're seeing in these charts, is a key leading indicator for cloud growth. Data show deceleration across the board. perhaps more accentuated in AWS and GCP. So I know we get Microsoft numbers tonight. Not as much of an impact there, given the higher enterprise mix. So AWS, by contrast, that is driven by a higher SMB mix. So AWS makes our list of potential areas of concern heading into 3Q. So in conclusion, so CFO in the driver's seat, cloud, SMB, nice to have, SaaS, all facing optimization. Social network defects, that shift in landscape is picking up speed. Big ticket purchases on hold, so traffic is accruing to Amazon and promotional D2C at the expense of big ticket categories like home and electronics. Streaming race to the bottom, so signups are beginning to stall, and that's forcing some change, accelerating growth figures. And then finally, return to office resistance is withering, so companies with categories and companies benefiting from work from home flexibility. It's just a continuation, it's a slow bleed. They're seeing extended pressure in this quarter and will likely make for a foggier outlook in 4Q. So that's it, and happy to take questions online or offline if you have them. Feel free to raise your hand and shoot them in. Even before tax season, or even after tax season, we're seeing a pretty substantial amount of the funnel traffic going to the tax side. It's roughly, and I need to follow up on the numbers here, but roughly 30% of all of the interest. So that's a very clear winner here for LegalZoom. It's just not going to drive the transaction growth this quarter as they need it. On the page registration, we're going to get back to you on that one. That's a reflection of referral traffic into the page. So this is the question on how do we calculate the payment penetration of Mercado Libre and then listing the same thing. So we have specific methods that we're able to map out exactly how the user is flowing through the funnel and who's selecting a Mercado Libre based payment. Separately on the listing side, who's selecting fulfillment. So these are what we call segments internally at our company. But these are very specific pieces of the URL that we're able to map out and get a penetration rate. So that's going to do with questions today. Thank you everyone for joining. I really appreciate all your time, and feel free to send any questions in email as a follow-up. Happy to answer them all. Thank you everyone for your time.